When stock markets crash, people don't just lose money. They lose confidence. They lose direction. And sometimes they lose their future. Families panic. Companies collapse. Governments scramble. And entire nations feel the shockwave. But here is the most shocking truth. Some of the greatest fortunes in modern history were created during a crash, not during a boom. While millions were panicking, a small group of people were quietly accumulating. And the question that always comes back is, why? Why is it that when markets fall, the majority lose everything, but a tiny minority get rich? Is it luck? Is it manipulation? Is it insider access? Or is it simply understanding what is actually going on? Because crashes are not random storms. They are not mysterious financial curses. A crash is a very specific chain reaction. Human psychology, plus liquidity, plus fear, plus leverage, suddenly collapsing at the same time. Before we talk about how people profit during crashes, we must understand what actually causes them. Because every crash, from the Great Depression to the dot-com explosion to the 2008 housing meltdown to the COVID panic, was not an accident. There are patterns, repeating patterns, patterns that keep returning because human behavior repeats again and again. The first and most important root cause, bubbles. A bubble forms when something becomes exciting, popular, and overbelieved. It starts innocent. This thing is the future. This company will change everything. This stock will never go down. Then people don't just invest with logic. They invest with emotion. Excitement becomes overconfidence. Overconfidence becomes delusion. Delusion becomes worship. And then people start borrowing money, not because the investment is safe, but because they fear missing out. That is when the bubble reaches its most dangerous point. Not when prices are high, but when expectations are insane. At that moment, the price no longer reflects reality. It reflects fantasy. And fantasy is never sustainable. So it bursts. And when it bursts, the crash begins.
But bubbles are not the only cause. There is a second force. A force more powerful than hype. More powerful than social media excitement. More powerful than any trend. That force is economic reality. Cause number 2, bad economic conditions. When the real economy slows down, when companies earn less, when households spend less, when unemployment rises, the stock market gets nervous. Stocks are not magic objects. Stocks are digital pieces of businesses. So when business isn't growing, prices eventually fall. The crash is not the moment prices fall. The crash is when everyone realizes at the same time that prices were too high for the real economy underneath. Investors don't panic because prices fall. Prices fall because investors panic. This is the difference between a dip and a disaster. Cause number 3, government policy shock. Sometimes it's not companies. Sometimes it's not consumers. Sometimes it's policy. When central banks raise interest rates aggressively, borrowing becomes expensive, credit slows, growth slows, and markets collapse under the weight. This is exactly what happened many times in history. Markets are allergic to sudden interest rate shock. Even a 2% policy change can crash a trillion-dollar market. Because investors don't react to reality, they react to what they fear reality might become. Cause number 4, black swan events. Black swans are rare events that nobody saw coming. Examples: the COVID pandemic shutdown, Russia's invasion of Ukraine, 9/11 attacks, 2011 Fukushima nuclear disaster. These events are not financial in nature, but they trigger chain reactions in financial systems. Airlines collapse, oil markets flip, supply chains freeze, investor fear spikes. Black swans are not the most common cause, but they are the fastest cause. When a black swan hits, the market doesn't walk downward. It falls like an elevator cable snapping. So now we combine everything: bubbles, irrational optimism, bad economics, slowing growth, rate shocks, policy tightening, black swans, unexpected emergencies. And when even one of these is strong enough, the market cracks. When two or three combine, the market crashes. When all four combine, that is when we see history.
There is a painful truth most people do not want to hear. Stock market crashes are normal, not rare, not unusual, not unpredictable. They are a repeating feature of capitalism, not an exception to it. The problem is not the crash. The problem is that most investors think the market is supposed to always go up. But if a market only went up, it would not be a market. It would be a fantasy. Crashes are not interruptions. Crashes are resets. They are price corrections that bring stocks back to reality. And this is extremely important. Almost every crash in history was followed by recovery. Sometimes the recovery was slow, sometimes fast, but the pattern is the same. Markets fall, then rise to new highs. Because capitalism reinvents itself. It breaks, then rebuilds. And this is why understanding history is critical. Because history reveals that crashes are not abnormal storms, they are cycles. Pullbacks versus corrections versus bear markets versus crashes. Most people confuse every drop as crash, but there are levels, and each level has a different meaning. Let's break them down. Level 1. Pullback. A pullback is a small drop, usually 5% or less. This is like the market taking a breath. Not dangerous, very normal. Level 2. Correction. This is around 10% or more. This is uncomfortable. People start getting nervous. Media headlines start to change tone. Uncertainty returns. But corrections are routine. They happen almost every year somewhere. Level 3. Bear market. This is when markets drop 20% or more. Now sentiment changes dramatically. Fear rises. News becomes heavy. People start selling not because they want to, but to stop the pain. Level 4. Crash. This is a sudden, violent drop. Fast, rapid, emotionally explosive. This is panic. This is forced selling. This is where fortunes get destroyed overnight because people react emotionally, not rationally. And here is the twist. Crashes create millionaires because most people react emotionally, but a minority react strategically. Now, this is where the shift happens, because if crashes are normal, then the question is not,
will another crash happen? The correct question is, how do I position myself before it happens? Because if crashes are unavoidable, then preparation becomes more important than prediction. If we look back at history, markets have crashed again and again and again, and yet the long-term trajectory is still up. That is not theory. That is not motivational talk. That is actual recorded data. Some examples. 1929, the Great Depression. Stocks fell 89%. 1987, Black Monday. Stocks fell 22% in one day. 2000, dot-com bubble burst. 2008, global financial crisis. 2020, COVID crash. 5 different decades, 5 different triggers, 5 different stories. But all 5 had one identical outcome. The markets eventually recovered and then reached new record highs. That pattern is one of the most powerful lessons in finance. Why? Because markets are driven long-term by innovation, productivity, and population growth, not fear. Companies fail, technologies change, old names die, new names rise, but the system as a whole keeps pushing forward. The Dow Jones was not powered by Facebook in 1960. It wasn't powered by Amazon in 1990. It wasn't powered by Tesla in 2005. It wasn't powered by Nvidia in 2010. But every decade, new companies rise and replace the old. The market is not the same group of companies forever. It evolves. And this is the hidden secret that makes crashes temporary. Markets don't rise because old companies recover. Markets rise because new champions emerge. So when people say, "But this time is different, this crash feels worse," they are half correct. Every crash feels worse when you are inside of it, because fear makes the present feel unique. But statistically, it is not unique. Humans panic the same way in every era. Greed looks the same in every decade, and recovery follows the same general arc. The problem is that most people only look at the crash. They do not look at the recovery. They see destruction, not creation. They see panic, not opportunity. They see loss, not potential. But the wealthy see something else entirely. They see valuation discounts, because a crash is nothing more than every asset going on a temporary sale while the majority of buyers run away from the store.
Now we enter the part that most people never learn, because most investors are not educated, they are emotional. And emotional investors do not profit from crashes, they get destroyed by them. But the wealthy, the strategic, the calm, the informed, they behave differently. They do not panic. They prepare. They wait. They study. And when fear hits the market, they do not run. They enter. Because to them, a crash is not a threat. It is a transfer event, a transfer of wealth from the impatient to the patient, from the emotional to the rational, from the panicker to the planner. This is why Warren Buffett says, "Be fearful when others are greedy, be greedy when others are fearful." Most people quote this line online, but almost nobody understands what it actually means. It means this: the best time to buy assets is when everyone else is trying desperately to sell them. Not because the world has ended, but because fear has discounted everything. Strategy 1. Stop panic selling. The first rule of profiting during a crash is not buying. It is not selling at the bottom. This is where most people lose. The crash does not destroy them, their reaction destroys them.
Because when you sell during panic, you are locking in a temporary loss into a permanent loss. A crash becomes fatal only when you exit emotionally. The wealthy know this. They do not sell out of fear. They sell only when price is higher than value, not lower. This is why the first move of wealthy investors during a crash is patience. Patience is a money-making skill. Strategy 2. Dollar cost averaging, or DCA. DCA is not a trick. It is not hype. It is not magic. It is mathematics. It means buying small amounts of assets regularly, especially when markets are falling, so you collect shares at cheaper prices automatically. Most people only DCA when the market is going up, which is the opposite of intelligent. Smart investors DCA more aggressively when markets are going down because they understand one truth. Buying during pain reduces your cost basis. Buying high feels safe, but it is foolish. Buying low feels scary, but it is intelligent. DCA takes emotion out of the process. It uses time plus consistency to capture natural recovery. And historically, investors who DCA through crashes outperform those who wait for perfect timing. Because perfect timing is impossible. Consistency is possible. Strategy 3. Focus on quality companies. When markets crash, everything falls. The good companies fall, the bad companies fall, the stupid companies fall, the genius companies fall. Crashes are not targeted attacks, they are blanket sell-offs. Fear does not differentiate. Fear does not say, "This is a strong business, I will leave it alone." No, fear says, "Sell everything, now." And this is where the wealthy have an advantage. They know how to separate the temporary pain from the permanent weakness. They know how to identify companies that may suffer during the storm, but still have the DNA to recover after the storm. These are companies with real revenue, real profits, competitive advantage, strong cash reserves, long-term demand, leadership that can navigate chaos. Because here's the secret. A great company on sale is one of the best opportunities in finance. Buying a weak company at a cheap price is still a weak investment. But buying a strong company at a discounted price, that is how wealth is built during chaos. Strategy 4. Diversification. Diversification is not a luxury, it is a survival system. Because during crashes, specific sectors can get destroyed even if the whole market recovers. For example, in 2000, tech collapsed, but oil and energy didn't. In 2008, finance collapsed, but big tech later exploded upward. In 2020, travel and airlines collapsed, but digital companies skyrocketed. So wealthy investors diversify not because they are indecisive, but because they understand something simple. You can't predict which sector will bleed the worst, but you can protect yourself by not putting everything in the same battlefield. Diversification is not about more stocks. It is about uncorrelated exposure. Different sectors, different industries, sometimes different countries, sometimes even different asset classes. Diffusing risk is how you survive when storms hit. Strategy 5. Killing FOMO. FOMO destroys more wealth than crashes. FOMO makes people buy high when everyone else is already excited. And then when the crash comes, they're the ones holding the losses. The wealthy do not chase hype. They do not chase trends. They do not buy because everyone is talking about this stock. They buy when value is present, not when excitement is loud. Because hype ends fast, value lasts. This is why the top 1% use crashes as entry points, not because the market is safe, but because the risk-to-reward ratio becomes favorable. They are not buying at the top of the mountain. They are buying near the bottom of the valley.
Strategy 6. Understanding psychological traps.
Most investors lose during crashes not because of math, but because of emotion. Fear, impatience, and anxiety push people to act fast instead of act smart. There are three main psychological traps during crashes. Trap 1, loss aversion. People hate losing more than they like winning. So when prices fall, they want to protect themselves by selling, even though selling locks in the loss. Trap 2, herd behavior. Humans feel safer doing what everyone else is doing. So when everyone is selling, the average investor copies. Trap 3, short-term thinking. People zoom in on today, not 3 years from now. They think the world has ended, even though history proves recovery. The wealthy are not more intelligent, they are more emotionally disciplined. Strategy 7, liquidity, the silent power tool. Cash is not exciting. Cash is not glamorous. Cash doesn't go viral. But during a crash, cash becomes king. Because when everyone is panicking and selling what they own just to survive, the person with dry powder, with cash available, can go shopping at unbelievable discounts. Imagine you walk into a store and everything is suddenly 50% off, but you are broke. That discount is useless to you. This is why wealthy investors maintain liquidity, not because they fear the market, but because they want to strike when everything is cheap. This is why Buffett says, quote, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." End quote. If you have no liquidity, you cannot put out a bucket. Strategy 8, short selling, explained simply. Short selling is not for beginners, but it is how some investors make money when prices are falling. Simple explanation. Normal investing, buy low, sell high. Short selling, borrow first, sell high, then buy lower later and return. It's like selling something you do not own yet because you believe the price will drop soon. If it drops, you buy it cheaper later and you keep the difference as profit. Example, you short a stock at $100. Later, stock falls to $60. You buy it back at $60. You return the shares and you keep $40. This is how some investors profit during the fall itself, not after. But short selling is high risk, and if the price goes up instead of down, your losses can be unlimited. This is why the wealthy only use short selling strategically, not emotionally. The wealthy do not get lucky in crashes. They are not guessing right. They are not better forecasters. They simply do not panic, maintain liquidity, buy quality at discounts, diversify smartly, avoid hype, and apply patience. These behaviors are the opposite of what the average investor does. That is why crashes become wealth transfer events. Every crash feels like the end of the world. During 1929, people thought capitalism itself died. During 2000, people thought tech was finished forever. During 2008, people thought banks would never be trusted again. During 2020, people thought travel would never return. And yet, markets recovered, and then reached new all-time highs. Why? Why does recovery keep happening? Is it magic? Is it luck? Is it manipulation by billionaires? No. There are 4 structural forces that make recovery almost inevitable. Force 1, human adaptation. Humans do not just sit and suffer. When a crisis hits, people innovate. New businesses are created, new technologies rise, new industries emerge. The world did not return to normal after COVID, it adapted into a new normal. Recovery comes from innovation, not from optimism. Force 2, capital reassignment. Money never disappears, money only transfers. During a crash, cash moves from weak companies to stronger companies. Investors stop funding the dying business models and start funding the new winners. When the internet killed bookstores, Amazon rose. When streaming killed DVDs, Netflix rose. When electric cars challenged combustion engines, Tesla rose.
This transfer is what powers new bull markets. Force 3, government and central bank intervention. When markets collapse, governments do not just watch. They cut rates, they inject liquidity, they pass stimulus, they support banks, they prevent system collapse. This is not conspiracy, this is standard macroeconomic defense. Because governments understand a collapsing stock market becomes a collapsing economy, so they intervene to stabilize the system. Intervention brings confidence, confidence brings buyers. Buyers create the early stages of recovery. Force 4, population growth and consumption. Markets are built on people. More humans, more consumption. More consumption, more revenue. More revenue, more profit. More profit, more share value. Even when growth slows, the direction is still forward over long time frames. People keep buying food, phones, medicine, cars, homes. This is why markets trend upward long term, even after destruction. And this is the key idea. Recovery is not a miracle. Recovery is structure. Crashes happen fast. Recoveries happen slow. But the upward direction ultimately remains, because markets are reflections of human progress, and humans progress through pain.
When markets recover, the shape of recovery matters, because every recovery is not the same. There are three major recovery patterns investors must understand. 1. V-shape recovery. This is the fast shock, fast rebound. Markets collapse quickly, but then bounce back quickly. Example, 2020 COVID crash. March 2020, markets collapsed violently. By late 2020, markets were already at new highs. This type of recovery usually happens when the cause was sudden, the cause was emotional, the underlying economy was still healthy. These recovery events reward investors who stay calm. 2. U-shape recovery. This one takes longer. Markets drop, then stay low for a while, then slowly climb back up. It's like hitting the ground and sliding before standing again. Example, 2008 financial crisis. Banks collapsed, credit froze, trust was destroyed. Even after the crash bottom, markets hovered for a while before lifting again. This recovery rewards patience and dollar cost averaging. 3. L-shape recovery. Rare, but real. This is the hardest and longest. Market crashes, and instead of bouncing back strongly, it drifts sideways for years. Example, Japan in the 1990s. The Nikkei crashed in 1990, and decades later, it still hadn't fully recovered to old highs. This usually happens when demographics decline, innovation slows, new industries fail to replace old ones. These recoveries test investor emotional stamina. The hidden lesson. Most investors don't even know which shape they're inside. They don't have the emotional zoom out. Why? Because humans feel the pain of today, not the reward of tomorrow. Time is the greatest compounding weapon. This is where the wealthy dominate. They are not playing the 3-month chart. They are not playing the 1-year chart. They are playing the 10 to 20-year chart. Because on long time frames, crashes become tiny dips on a rising curve. The graph of human productivity is up. The graph of innovation is up. The graph of population is up. Therefore, the long-term graph of markets tends to go up. Not smoothly, not linearly, not gently, but upward. Now we must go even deeper. Even though recovery is natural, most people never benefit from recovery. Why? Because most people do not stay during recovery. They sell during fear. They exit during pain. They leave before recovery begins. They turn a temporary loss into permanent failure. The emotional cycle of crashes, why human emotion destroys wealth. People think markets are numbers. No, markets are
Emotions. The candles, the charts, the green and red bars, they are just digital reflections of human behavior. The biggest crashes in history were not caused by math. They were caused by psychology. So let's break down the emotional cycle step by step. This is the invisible pattern that repeats again and again in every bubble, every bull run, every crash. There are 7 emotional stages that almost every investor goes through. Stage 1, optimism. This is when markets start rising slowly. People start believing, wow, things are improving. The news gets a little positive. Friends start talking more confidently about money. People begin investing, but cautiously. Not greedy yet, just hopeful. Stage 2, belief. Prices are rising consistently. People are making money. Now confidence strengthens. People say, maybe this time is different. Now industries start getting spotlight. Videos, blogs, channels start talking about opportunity. This is when new money starts flowing in. Stage 3, euphoria. This is the deadliest stage. This is when most fortunes are lost, not when the market crashes, but during the peak excitement right before it. Because people go all in. They borrow money. They buy aggressively. They stop thinking logically. They believe this will never go down again. TikTok and YouTube becomes full of millionaire in 3 months content. Influencers brag, celebrities enter the market. People who never cared about money suddenly think they are experts. This is the precise moment when risk is highest, but people think risk is lowest. Stage 4, anxiety. Prices stop rising as fast, but people still believe it's temporary. They tell themselves, just a small correction, it will bounce back. This is denial. This stage can last weeks or months. Stage 5, fear. Prices continue falling. Now social media turns negative. People ask, what if the top is already behind us? This is when people begin selling. Sometimes they sell just enough to feel safe, but not enough to actually protect themselves. Stage 6, capitulation, the moment of maximum damage. This is the official panic crash. This is where the massive selling begins. People cannot take the pain anymore. Influencers disappear. Investment YouTubers go silent. Comment sections become depressing. People sell everything at the bottom because they cannot emotionally handle the red. They say, I just want out. This is where people permanently lock in losses. Stage 7, disbelief, the beginning of recovery. Prices begin rising again, but no one believes it. People think this is another trap. It will fall again. The same people who bought at the top refuse to buy at the bottom. Recovery quietly begins with very few participants. This cycle repeats again and again and again. Different actors, different generations, same psychology.
Now that you understand the emotional cycle, here is the shocking truth. The rich do not buy what the poor buy. The rich do not sell when the poor sell. The rich wait. They sit patiently. They wait for fear. They wait for panic. They wait for capitulation. Because the wealthy understand something most people never learn. Real wealth is created during maximum fear, not maximum excitement. Let's decode how they think. When the poor are in euphoria, the peak of the bubble, regular people are buying aggressively. They are chasing hype. They are copying influencers. They are afraid of missing out. But the wealthy? The wealthy are quietly selling. They are exiting positions, not loudly, not publicly, not on TikTok. They sell slowly, silently into the excitement of the masses. Because the rich understand, greed is the most dangerous signal. When the poor are in capitulation, the bottom of the crash, regular people are selling everything. They say things like, "Stocks are dangerous. I'm done with investing. This is not for me. The market is rigged." They dump their assets at the lowest prices. But the wealthy? The wealthy are buying. And they buy in large quantities. Example, during the COVID crash in March 2020, the S&P 500 dropped over 30% in 1 month. Guess who was buying? Institutional funds, pension funds, sovereign wealth funds, billionaires, elite private equity groups. They were not panicking. They were shopping. Here is the pattern you must learn. The rich buy fear. The poor buy excitement. The rich sell excitement. The poor sell fear. That single sentence explains every wealth shift in every crash. And here's the hardest part. It feels wrong emotionally. Buying when everyone is crying, selling when everyone is celebrating. Emotionally, it feels opposite. But that's why it works. Because markets are not logical, they are emotional. And the few who master their emotion control their financial destiny. How market bubbles form. The science behind hype. To understand stock market crashes, you must first understand the bubble. Because every crash is simply the explosion of a bubble. But bubbles don't appear suddenly. They build slowly, like a balloon being inflated tighter and tighter and tighter until eventually pop. The pressure cannot hold anymore. So let's break down the exact steps that form a financial bubble. There are 5 stages of a bubble. This pattern appears in .com, 2008 housing, cryptomania 2021, AI stock mania, even meme stocks like GME and AMC. And it never changes. Stage 1. The displacement. This is when a new powerful idea enters the market. Something new and exciting. Examples in history. The Internet, 1995 to 2000. Housing loan securitization, 2003 to 2007. Blockchain and crypto, 2016 to 2021. AI and machine learning, 2022 to present. At this early stage, very few people notice. This is when early investors, the smartest money, enters. This is where tiny positions can multiply massively later. This is where Amazon was $1.31 per share. This is where Netflix was $0.78. This is where Tesla was below $2 pre-split. These are the seeds. Stage 2. Professional investors start buying. This is when hedge funds, VC firms, and institutions start moving billions in. This is when the idea becomes serious. The technology or theme enters mainstream media slightly, but not fully. This is when Ripple, Ethereum, Nvidia, Meta, early Google gained legitimacy. At this stage, the wealthy are positioning for the future, not for hype, not for virality. They are buying because they see real economic value. Stage 3. Public enthusiasm and mass retail entry. This is when normal people start entering the market. This is when your neighbor suddenly becomes an investing expert. This is when TikTok and YouTube explode with content. This stage is powerful because this is where demand becomes uncontrollable. At this stage, the prices rise not because of value, but because of fear of missing out. FOMO turns into fuel. This is when the bubble inflates aggressively. Stage 4. The mania. This is the peak insanity zone. This is when people take loans to invest. People sell their house to buy stocks. People invest without research. People stop listening to logic. Charts are vertical like rockets. Media becomes overly bullish. Influencers become reckless. Everything becomes exaggerated. Everyone claims to be a genius. Everyone thinks nothing can stop the rise. People start saying sentences like, "This time is different." That is the exact moment the bubble becomes fragile. Because when everyone believes it only goes up, nobody is prepared for down. Stage 5, the blow-off phase. This is where everything crashes, and it always starts the same way. A small negative event triggers a chain reaction. One bad news headline, one lawsuit, one economic report, one earnings disappointment. Suddenly, confidence cracks. The bubble doesn't slowly deflate, it explodes. And this is why crashes look violent, because there were no real support floors. The price was based on emotion, not fundamentals. So what happens? People who bought late panic sell instantly. Stop losses trigger. Margin accounts liquidate. Fear spreads like wildfire. People who were millionaires on paper become broke in 2 months. This happened in 1929, 2000.com, 2008 housing, 2020 COVID crash, and 21-22 crypto collapse. Every bubble follows the same 5 stages. Now listen carefully. Bubbles are not accidents. They are predictable psychological events. If you learn to identify the stages, you will never be surprised again. You will know exactly where you are in the cycle, and you will be able to position yourself differently from the herd. What actually causes crashes? The real engines behind market collapses. Most people think stock markets crash because politicians, presidents, a single bad news headline. No, those are just triggers. A trigger is the match, not the gasoline. Crashes do not happen because of one event. They happen because the system was already unstable and then something small ignited it. So let's break down the real underlying causes, the structural forces that make markets vulnerable. There are 6 primary root engines. Number 1, massive overvaluation. This means asset prices are far above true fundamental value. Example, in the dot-com bubble, many companies had 0 profits, 0 real business model, 0 revenue in some cases. Yet they were valued at billions. Same in meme stocks 2021. Same in some AI stocks now. When price equals fantasy, risk becomes nuclear. Because every dollar is built on hope, and hope is fragile.